Welcome to this episode number 42 of Your Next Trade, called today Consumer Credit Cracks. So over the last few days, we have seen some cracks coming and starting both in the consumer and in the credit market. Let's start first with the consumer, looking at the XLP, which is the consumer staples, where we have seen over the last couple of days on Tuesday and Friday some weaknesses. So Friday we saw the bounce because the market bounced after the NFPs. But if you look at names like Coca-Cola, Unilever in Europe, Nestle, McDonald's, we have seen really weaknesses over the last few days and over the last few months. On one part, you can explain this by apparently a fantastic pills that is helping obesity and people having less calories to eat every single day. But very clearly, there is a sign if you look at retail, if you look at consumer staples, the price action for several stocks is telling you that consumer in the US is starting to see some cracks. So that is something that I've been talking for months and months, that starting roughly Q4, October, we should see the US consumer weakening. And we do know the importance of the US consumer, as it makes 70% of the US GDP. Another sign that under the mattress, there is a bit of pain starting. So far, the credit spread, meaning the spreads in the credit market, were holding pretty well. Over the last, let's say this week and over the last few days, we have seen some credit spreads widening, not huge, but we start to see some signs. So if you look at the different ratings, if you look at the triple B, if you look at the triple Cs, if you look at high yield, the spreads between those bonds and the treasuries have been widening a bit. So this is something that you should be really looking at. We do know that with the US 10 years, with the yields all over the world that went from very low level in 2020 to pretty aggressive level now in 2023. So we went on the US 10 years from very low level to 4.8% as of Friday close. That is going to have a repercussion on both the US consumer and on the credit market. Coming back on the US consumer, there is another point that is very important. We do know that most of US companies and world companies have been able to pass on prices, but actually the volumes were flat to small down. So if you look at what we call the mix, which is the volume times the prices, most companies were seeing, small to flat sales year on year, with prices up between 10 to 20%. And that was possible as long as you got pricing power. In other words, that you are able to pass on to the consumer the rise of or the inflation. It seems that there is a limit to that. You can see if you think that the price action of stocks is a very good leading indicators. If you look at consumer staples, if you look at, as I said, names like McDonald's as well, if you look at Costco, if you look at Walmart on Friday, coming into the earnings season that will start on Friday, mostly with JP Morgan, that is a good tell that the US consumer is probably weakening. So let's start as always with the week 2 data set performance. As we can see on the left hand side, the S&P was small up 0.5%, the Nasdaq 1.6%. As we're going to see later, it is mostly driven by very few names. Europe was pretty weakish, down 1 to 2%. China was closed for the week, so we're going to be having China back on track on Monday for the markets. In terms of currencies, dollar is weak, is flat on the week, but we had a very strong rally after the NFP numbers. So if you look at the euro dollar, we went from 1.1048 to 1.06 roughly at the close. So very strong move. WTI very weak. Before, that is something that we discussed last week. WTI was pretty strong due to the backwardation, and this week we have seen a huge weakness That was partly explained by some data that were saying that actually the consumption in the US in the gasoline was not as strong as expected. I'm not reading too much into those numbers. There is huge volatility, and I think there's still a supply constraint, which should see the oil well bid, and we've seen as well, starting from today, unfortunately, that the Middle East is under pressure. So there is a lot of tension, and more than tension, in Israel with some attacks. So that's going to create more tensions. You can expect probably in the next few days or few weeks, Israel going after Iran and going after the financing of what is happening. So, but overall, if you look at the world and the consumption of commodities through the WTI and copper, that is not a good tell of that is not really telling you that the world is that strong. So, I'm really interested about this week-to-date industry performance because to explain the divergence. So, if you look at the S&P that is here, you only get very few industries that are up and a lot of industries obviously that are down. So what does it tell you? If you look at the names that are here, we are talking semiconductors, technology. So roughly what you have is the same names as before that have been driving the market, the Magnificent Seven and others. But overall, the market has been very weak inside. So if you look at the losers, solar, oil services, energy, but very many names, many industries that have been underperforming the market overall. So what we call the market breadth for the week has been pretty bad, and is mostly the bounce that we had on Friday was mostly driven by very few names, the tech names, and as well as we do know now, very often what happened on Friday, there is this huge move due to options that are expiring on the Friday. So the gamma of many of those stocks have been helping the rally that we saw from the opening to the close. So what about now looking at the sector's performance? So the year to date, pretty much the same picture, but similar, the energy obviously going hand in hand with WTI, very weak, -5%. We looked at it, I think it was 3 weeks ago, to the charts, was about to be making a breakout. So far, obviously that is not making it. But interestingly, the consumer staples down 3%. So consumer staples, which normally are seen as pretty safe or defensive when nothing is really working or when the market is in risk off. So as I've been saying, the issue with consumer staples is the pricing power. So what those companies have been brilliantly doing over the last 18 months is raising the prices when actually volumes were flattish to down. My view is the following, is the market is pricing that it's going to be much harder in 2024 for those companies to be raising prices because the elasticity is now minimum and more or less the consumer is saying, I can't be having more price pressure and prices going higher. So those companies are now facing this limitation in hiking prices. For the rates, that is an interesting week because if we look at the S&P, at the Nasdaq, we are flat to small up. But if you look at the bonds, if you look through the 10 years, looking at the 10 years in the US, we are at 4.8%, whereas as of last Friday, we are around 4.55 to 4.6%. So bonds selling off even more, yields going higher, and that's true not only in the US, that's true in Germany, rest of the world. Similar here, China was close, but yields are going up. Look at this steepening, the bear steepening of the yield curve. It's the same. We are getting closer now to getting positive. So bonds are still going into the same mode. There has been a bit of divergence between bonds and stocks going for this week, mostly on Friday. Looking at the FOMC expectations, not much of a change between last week and yesterday. So you can see all along those different maturities, it's more or less the same. And looking at what the market is pricing in terms of peak, so the peak should be moving here, which is roughly January. Market is pricing roughly a 50% chance that there's going to be another 25 bips hike, but not much, not more than that. In terms of volatility at 17.5% as of yesterday. We went into the 20% on Thursday, so I had some puts on the S&P. So I think when you have options, be extremely careful, call or put, because obviously volatility, implied volatility that you'll be paying is extremely important. So I managed to sell some of my exposure, my downside exposure that I have when volatility was at 19.5, 20%, roughly not all of it, half of it through options, and I'm still carrying some short with the SPY. So volatility came down a bit on Friday after the NFP, and as always when market participants, at least for this year, have been seeing like high volatility or higher volatility. They have been dampening the volatility, which has been helping the market to go up. So we flipped from the early session yesterday from buying puts to buying calls, and that explained some of the move that we have seen in the last part of the session. So looking at TLT, normally I start with the S&P futures, but I think today it was important to look at the bonds. So it's not perfect, but for the retail traders, ETFs to the TLT is one of them. You can be using AGG or some others, but TLT gives you exposure to the long-term bonds to 20 years something in terms of maturity. And what we are looking at is obviously when bonds are selling off, when yields are going higher, bonds are coming down. So what has been interesting is we are still in the mode, in the setup where people both for the equity and the credit market think that at one stage the Fed will come back, will jump again, and will be buying bonds, buying stocks. Okay, not buying stocks literally, but helping the market through QE. So many people on Twitter, on social media, people that have 50, 100, 200, 500 followers have been trying to pick some levels on the TLT or some bonds, telling you this is the bottom. So that was the bottom when it was at 125, it was the bottom when it was at 110, and at 90, at 85. What is quite funny for me as an equity guy, as a stock trader mostly, is when I see those people who have been telling me for years, Greg, don't catch a falling knife. And in the meantime, they have been, trying to explain you for hours and hours what is the risk management. And they are trying to pick the bottom on the TLT. The bottom line is, many market participants are thinking the same mode that we have been having for the last 15 years, that, central banks, QE, they will be jumping again. What about we get something different? What about, yields go to 5% and above and stay there for quite a long time, and we have a bit of sticky inflation, for instance. So think about, the other way of what is the consensus might be thinking. What about the S&P future? So the chart that I had before was not perfect because actually I think there's a mismatch with one of the candle here from TradingView, so I had to adjust it with my Bloomberg. So we managed to pick the level that was making those trend on the S&P. If you look at the volumes that will be down here, there has not been like crazy volumes. Okay, so we managed to bounce or to test the 4250, not the 4200. So I would have liked to see the 4200 because it was a very important level. I still believe this is an important level, and I want to believe that the move that we had as of yesterday was not a clean one. We could see a bounce, of a few percent, but I think the underlying story is still the same. If you look at Europe, if you've been trading Europe or US, the volumes are pretty much the same from one day to another. So if you want to see an extreme in the market, very often you need to see a much higher volume at the bottom or at the peak, which we didn't have so far. So we have this bounce. We have this bounce here as well on the Nasdaq. On the Russell, we do have a bounce. So if you look at the Russell versus the Nasdaq versus the Russell, you see that we are making new highs. So the picture is still the same. People are buying some winners, very few winners. So that will be the magnificent seven that everyone is talking about, this Meta, Amazon. So you get the names here versus the S&P. As you can see, despite the fact that they are making 30 to 40% of the S&P, they are still making new highs. So looking at the table that we've seen before, market is very much driven still by very, very few names. I'm interested now into JP Morgan. Why? Because on Friday we get the earnings from JP Morgan. Price action recently for JP Morgan over the last 3-4 quarters have been pretty good, but banks price action, consumer staples price action, different sectors have not been great. So that will be a good tell for this earnings season coming. Looking at CL1, so that has been the jump that we mentioned. I'm not sure, but to be honest, I don't have a clear view on CL1 here. Structurally, I think there's still a question of imbalance, but it feels the volatility for me. I can't really deal with the risk management here. Copper, I think the move is lower. It has been broken, and that tells me that the world is not great in terms of macro, and China is not doing well. Gold, I think, has been pretty painful for many people, which were thinking, we're going to be holding this 1900. We have been on a one-way traffic. Euro dollar, big move yesterday. As I said, big move, 1% move from the lows, a bit of volatility before the NFP, but the trend is similar. Same with dollar yen. There has been a bit of intervention, even if it was not confirmed. I think it was on Wednesday when we went just above the 150, so that would be this candle up, so that would be this candle went to 150, many headlines 150, then we went from 150 to 147, low 147. That was not confirmed that the Bank of Japan was intervening, but if you have a 2% move on dollar yen, that is probably actually that the Bank of Japan was intervening. Europe, bit of a bounce at the end of this week, but I think the picture to me is pretty much the same, that we should go lower. Going back now about what happened this week. So starting with the S&P futures over the last 5 sessions. So we started here, we finished here. So we are roughly up, small up, 50 bips. But overall, first 3 days, bit of weak market. So the ISM manufacturing is around 49%, so below 50% in contraction, but not going lower. So there are hopes that manufacturing is holding. Bouncing will be a big word, but actually, if you look at the ISM services, which was on Wednesday, the headline number was at 53, but there were 2 concerning numbers. The first one was actually new orders into the 51. So new orders have been slowing down a bit. It's only one number, but I think the same as before, which is ISM services will be following the ISM manufacturing, which has been lower. And the second thing, the prices from the ISM were still at the 58 level, so pretty high level. Then, on Friday, we get the first reaction on the NFP. So very good number, or high number for the Biden administration, 350,000 creation of jobs, and then we bounce. So there are 2 different ways to look at it. I still want to believe that the quality of the jobs that were created are not good, because we are not talking about temporary, long-term jobs, but temporary jobs mostly. There is a lot of seasonality that explains the numbers, so there is a bit of divergence. And my view is, and probably the same with you, is this is a lagging indicator. So when the pain will start, we're going to have some numbers confirming that the US economy is actually slowing. What about the second chart, which we have been talking over the last 3 episodes now, which is looking in white with the US 10 years, so that will be the futures, and in blue here, so that will be the S&P. So as we can see, we have been following each other for the last few days and weeks, and on Friday, a bit of a divergence where the S&P maybe not overreacted. We're going to see in the next few days, but actually a start of a bit of a divergence, at least between bonds and the stocks and bonds with other asset classes. So from September onwards, we've seen a huge correlation between bonds and anything. Okay, so with the 10 years, so you'll be following the 10 years. You could have been only trading the US 10 years. That would have been the same as the S&P in terms of direction. On Friday from 3 p.m. In the UK, so let's say from 30 minutes after the open in the US, we started to see divergence from the US 10 years and the rest of the market. And as I've been saying, if you think about it, this week, US 10 years went from 455 to 480, and in the meantime, the market, the equity market, managed to be up. So pretty strong market despite yields going higher. So NFP much better, services a bit lower, manufacturing consolidating. As I said, cracks in credit and consumer, and I want to talk now about something that I've been mentioning over and over, which is the market breadth, which is mostly this market is driven by very few names. So if you look at the S&P for the week, which was up to roughly 22 points, in the meantime, the Magnificent Seven altogether we're making 45 points, which is 2 times what the S&P was up on the week. And if you look at the Nasdaq 100, plus 262 points on the week, and the Magnificent Seven made up 242 points, so roughly 90%. So if you think about healthy market, it's the same. It's quite hard to be doing the hedging through the SPY, through some others. I had some sufferings through the XLP, for instance, versus the SPY, because it tells you that this market is very much driven by very few names. So that's easy to be saying, I'm making a lot of money. You've been making quite a good money if you've been into those 10 names. So if you look at the S&P, if you take the 493 S&P versus the S&P Magnificent Seven, there is obviously a huge divergence. So as long as we get this divergence, market is the same condition. I don't think that there has been a lot of change week on week, despite except the Friday divergence between the S&P and the 10 years. So we'll see in the future how it's going to be. So for this week, important week coming, because we do have a lot of macro numbers, earnings, and some others. So we get the PPI and the CPI. So inflation. So far, recently, if you look at the CPI here, so the expectation, so that will be on Thursday, plus 0.3% month-on-month expected and 4.1% year-on-year. But as you can see, the market recently has been pretty much didn't care about the inflation. As if, market is saying inflation is still pretty high, but I want to believe that inflation is coming down. So that is not the biggest worry of the market. We'll see if we're going to carry on like this. So that's for the CPI, the PPI. Second part is this one, which is the earnings. Why those earnings are important? Because on Tuesday, we got already 2 names important. We got PepsiCo. So we do know that the XLP, the consumer staples, get hammered over the last few days. And as one of the big names in the XLP, PepsiCo is going to give us some picture, some color. Second name is LVMH, which going to be doing its earnings right after the European close on Tuesday. And that's going to be an important tell about how China is doing, how luxury is doing, and how the consumer overall has been doing. So LVMH, if you look at luxury, they have been saying for the last 2 quarters that the US consumer has been struggling. Okay, so that's number one. So far, Chinese numbers were pretty good. So we'll see if they are keeping those strong numbers. And overall picture for the consumer. PepsiCo, that is the same. How can they pass inflation? How can they have a good mix going into 2024? As I've been saying already 3 times today, so far volumes have been down for most of those players when prices were up 10 to 15%. I don't think that the pricing power is going to work that much and the elasticity will be that good in 2024. Then we got some other names, the Domino's Pizza here on Thursday, but I'm interested obviously on Friday. Friday is really when the fireworks of this earnings season is starting with JP Morgan, Citigroup, Wells Fargo, UNH, BlackRock. So we do have like many names. I'm interested to start with JP Morgan here. So JP Morgan recently, price action have been pretty good into the earnings, whereas before it was pretty shite. Sorry for my English. Last 4 quarters, pretty good. We have seen that Jamie Dimon is telling investors that they should be ready to have the US 10 years going into the 6%. we are always interested to look at JP Morgan because this is a good market leading and obviously a big leader in the banking, and tell you how the US consumer is doing, how the US companies have been doing. So a big tell, JP Morgan, what is pricing for the market? And I think looking at those of you who are trading options, what is interesting is if you look at the last 8 earnings, JP Morgan has been moving by 3.6% on average, whereas if you look at the straddle for next Friday, market is pricing a 2.9% move. So does that mean that across assets, I haven't done the work yet, that the market is pricing lower implied vol than the usual historical volatility? That will be something to check, because as volatility has been on the way up recently, but overall was pretty down. I'm interested in how the market is pricing volatility going into earnings versus history. Finally, so that's the third kernel. So we do have like a lot of Fed speakers. The market is closed on Monday for the bond market. So actually for the stocks, that will be kind of playing and not looking at correlation with the US 10-year, so that could be a good thing. So a lot of Fed speakers. We have a lot of auctions, bonds auctions, so 46 billion 3 years on Tuesday. On Wednesday we had 35 billion and 20 billion. We do know that we do have a lot of supply coming to finance the budget. Finally, we get the FOMC meeting minutes. So that will be on Wednesday. Okay, so that will be some of the drivers that we have. Finally, looking at the weekly straddle, we are at 1.7%. The lowest level that we had recently was, I think, 1.1 to 1.2%. And we have as well some headlines that, unfortunately, as I said before, are starting to push quite hard, which is the conflict in Israel with a lot of attacks coming from outside Israel and inside Israel. So that will be making the headlines. My gut feeling is, as always, there's going to be repercussions. You can make sure that in the next few days, there's going to be probably some attacks from Israel to Iran. But that means the overall Middle East will be under pressure. So that will be not only for the headlines, but obviously looking at oil, looking at risk off through the gold. And as oil has been pretty high, and that's an understatement at $85, but went to 95, that will be a space to be looking at. So consumer, credit spread, oil, CPI, PPI, many earnings and auctions on the bond market. So this is it for me for this week. As always, if you get questions, 4x4 video series mentoring. If you like what you've seen, if you get some comments, feel free to subscribe to the channel. Feel free to put a comment, and I'll be very happy. We will all be very happy if you can bring some good knowledge on the trading community. There are some 3 channels that are for free on Discord, and that will be a good thing to see you next on the community. So many things for this week, many drivers. Something that I didn't mention as well, I mentioned last week the special situations. So actually special situations, all the spin-offs, we had 5 of 6 between Europe and the US were absolutely destroyed over the week. So there was quite of a change in the special situation of a spin-off. Is it because some prop desk or some pods are under pressure on that specific strategies? But very rare to see the spin-offs, most of the spin-offs going down 20 to 30% over the last week. So something to keep an eye on. I'm watching those names and some others. This is it for me for the week. See you next week. Bye-bye.